In crypto, it's never just about how much money you make. It's about how much you keep and don't lose. During the bull market euphoria phase, making money is easy. Everyone thinks they're a genius when the charts are flying. But here's what separates the pros who do know what they're doing from the crowd, everyone who just got lucky. Do you know when to take your chips off the table? Because if you look at the history of the game of crypto investing, the people who get hurt the most aren't the ones who missed the early moves. It's the ones who rode their winnings straight into the next crash. We call that round tripping. So how do you avoid this fate? How do you know when a true Bitcoin top has formed before the rug gets pulled? Here's the uncomfortable truth. When Bitcoin hits a real cycle peak at the very top, almost no one wants to see it. Euphoria literally blinds people. This time is different. Takes over their mentality. Calling a top feels almost impossible, right until it is the top and it crashes. Every major top in crypto history has sent out warning signs before the crash. Today, I'm breaking down the data due to popular requests too, so please do let me know in the comments always what you want me to talk about. Many of you thought this was a topic that you wanted me to cover. So today, as I was saying, I'm breaking down the data and the patterns and signals I watch so you can spot the red flags too and protect your gains, your investments, your earnings before it's too late and before you lose them. So if you want to keep your life-changing gains, because the money you can make in crypto during a bull run is life-changing. It literally changed my finances. Then this video is for you. So let's get started, guys, and happy Friday. But before we dive into the indicators and the cycle signals, let's take a quick look at what's moving the markets right now, so you're fully up to speed before we start breaking down some of these signals. So right now, the mood across crypto is very obvious. It's a palpable one. You can feel it everywhere. People are exhausted, frustrated, and more than a few are quietly wondering if this is ever going to pay off. There's this meme going around, you may have seen it, of just, "I'm tired, boss." And it sums up the vibe perfectly. It's what happens after weeks of just sideways price action trending, sharp pullbacks, and the headlines cycling between hope and fear. But here's the thing. Every person who's ever made it big in crypto, everybody who's walked away with life-changing gains has something in common, and that's grit. That's the ability to persevere and be patient and know your target and not waver. It's not about luck or always being the smartest person in the room. It's about showing up over and over and over again, even when the path seems foggy and the hype has faded. Right now, this is where champions are made. It's the training ground. And behind all of this fatigue, the smart money is still making moves. Here's what's actually shaping this market right now. Strategy. The company that's becoming Bitcoin's corporate whale and global ambassador for the Bitcoin accumulation strategy, has just announced it's raising another $2.8 billion through its new preferred shares to buy even more Bitcoin. That's a conviction level you don't see every cycle. And on the institutional side of things, Bitcoin ETFs snapped a streak again, bringing in $194 million just yesterday. That's big money buying the dip, while retail, or the 99%, are super nervous with their nerves all frayed. But it's not just about Bitcoin. Ethereum is stealing some of the spotlight. The new ETH ETFs are attracting strong inflows, a lot of investment. And for the first time in over a year, Ethereum's weekly spot volume has actually surpassed Bitcoin's, 25.7 billion for ETH and 24.4 billion for Bitcoin. When you see a shift like this happen, you know the energy in the market is rotating and the capital keeps flowing. Bitmine immersion, a public mining firm, just announced a plan to raise $2.5 billion to buy more Ethereum. Plus, now we see Mike Novogratz, one of the original investors in Ethereum, a proper Wall Street crypto OG, just went on CNBC and called it. Ethereum is going to outperform Bitcoin, he said. That's a headline you don't get every cycle either. And on the policy forefront, President Trump is literally patting Jerome Powell on the back at press conferences, half joking and half serious. You know, it's a tactic of putting him on the spot in public, joking or not, about wanting lower interest rates. Meanwhile, Scott Bessent is calling out the Fed for losing $100 billion a year and for out of control spending. So all this adds to the noisy, unpredictable macro market backdrop with political pressure on rates rising fast. So while it's very easy and understandable to feel drained, the chess pieces are moving and the big players are quietly positioning themselves for whatever comes next. And so should you. Smart money is acting, not reacting. And that's exactly the mindset you want in moments like these. And on the other hand, we can see tension in the charts. Since late June, Bitcoin has put on an absolute show, soaring from 98,000 all the way up to its recent all-time highs to $123,000, all in just a few weeks. But now we're moving sideways. We're trending, guys. And some altcoins have been getting hammered down 10, 15, even 20% in a single day. This kind of chop can leave anyone questioning their strategy, like what's going on. I get it. In times like these, the real edge comes from tuning out the noise and focusing on signals only that actually matter. Market psychology is key. Almost everyone wants to sell near the top, right? Like that's the dream we're all aiming for. But it's really hard to hit. And the truth is, essentially no one hits it perfect. And what's even trickier, I would say even more dangerous, but I don't want to use scary language, is it never feels like the peak when euphoria is everywhere and the crowd believes the rally will last forever. That is why relying on a single indicator never works. True conviction comes from confluence. Multiple signals lining up, all telling the same story or pointing in the same direction. With that in mind, it's time to break down the tools that help make sense of the chaos. First up, trend indicators. These help cut through the noise, revealing the real direction, momentum, and possible turning points in price. This is how serious traders avoid getting shaken out by short-term volatility. Because remember, it's about how much you save, it's about how much you retain and don't lose, and not always about how much you make. Because if you only make it on the chart and didn't take profits, then it doesn't matter. It's paper money. So let's get into it. Let's talk about indicator 1, the global M2 money supply. Now, don't let the technical names scare you off. M2 is just the measure of how much money is moving around in the world. Think of it as a giant pool that includes cash, checking accounts, savings, and anything else you can get your hands on quickly. Liquid. Can spend it or move it easily. It's part of M2, the M2 global money supply. And why does this matter for Bitcoin, you might ask? Well, history shows that when there's more money floating around, when central banks are printing, right, like they did during COVID, governments are spending, and the global money supply is rising, some of that cash almost always finds its way into risk assets, like Bitcoin and crypto is still considered, although Bitcoin is now finding its place in global reserve currency buckets of finance as well, like digital gold. So it's like, think of it when like the tide comes in at the ocean, you know, all the boats rise. Well, imagine Bitcoin and crypto have boats out on the water too, and they will rise too as the M2 global money supply tide rises. But here's the key insight. Bitcoin doesn't react instantly. It's like a domino effect. In fact, over the last few cycles, Bitcoin's big moves have tended to lag behind the changes in the global M2 money supply by about 2 to 3 months. Actually, in past shows, I have shown a lot of information on this as well, but there's a lag is all you need to know, okay? So it's not immediately. So anyway, what this means is that when the M2 global money supply starts to climb, you can expect Bitcoin to start running or start pumping shortly after. So you want to keep an eye on the global money supply, okay? And back in June, the global M2 hit a bottom and began to turn higher. And almost like clockwork, about 12 weeks later, Bitcoin ripped from $98,000 to over $123,000. You could literally see the money tide lifting Bitcoin higher and higher. And here's where it gets very interesting. Right now, the M2 just hit a new all-time high. This tells us, drumroll, there's more money in this system than ever before. Historically, every time this has happened, Bitcoin followed with a new all-time high of its own. Not instantly, but always within a few months, remember. So what does this mean for us? If M2 keeps rising, it's a major tailwind indicator for Bitcoin that Bitcoin is going to be pumping next. It's one of the strongest macro signals we have. And right now, it's telling us the wind is still at our back, pushing us forward. But it is key, once again, to remember it's a lagging indicator. So while it does not tell us the exact day to buy or sell, don't ever wait on that, okay? It does show us the direction of the tide, which is enough of a signal to tell you to get into position. The tide is still coming in. Now let's talk about the second indicator, guys, the pi cycle top. This is one of crypto's most legendary top calling tools or signals. You'll see people debating this indicator everywhere. The pi cycle top is built around two key moving averages. A moving average is simply the average price of Bitcoin over a set number of days. It smooths out all the very specific jagged movements so you can see the real trend in general. And in this case, we're looking at the 111-day moving average. So it gives us a big picture. Bitcoin's average price over the last 111 days and the 350-day moving average. But with the twist, that 350-day number is multiplied by 2. So in plain terms, you've got the line that responds quickly to price moves, and the other line that moves much slower, showing the long-term direction so you can compare both to each other. And the moment to watch is when the fast line, the 111-day moving average, crosses above the slower line, double line. Historically, it's this moment that has called the very top of every major Bitcoin bull run. Sometimes just a day or two before the final high, when Bitcoin goes absolutely parabolic, shooting up so fast that its short-term average leaves the long-term average in the dust. That's usually when markets get dangerously overextended. This is often when hype, FOMO, and euphoria peak, just before the crash. And right now, these two lines are not close to crossing. In past cycles, as Bitcoin neared its peak, before it crashed, these two lines we're talking about would race together and then meet almost suddenly. Except this time, as I was telling you guys, there's a healthy gap between them. They're moving closer, but we're not at the final sprint yet. The pi cycle top indicator isn't flashing any warning. We're not in that danger zone is what this means. And the market isn't acting like it's about to top out. So it's another reason to stay locked in and focused and not get caught up in all this fear you hear out there. Next up, let's talk about the third indicator. This indicator is called the Mayer multiple. This is a simple, visual tool that helps us figure out if Bitcoin is running too hot, too cold, or it's just right. Kind of like a thermostat when you're cooking. And here's how it works. The Mayer multiple compares Bitcoin's current price to its average price over the last 200 days. That 200-day moving average is a classic long-term trend line that filters out short-term noise and shows the real underlying direction. If Bitcoin's price is much higher than the average, the market might get frothy. And if it's way below, it could mean things are oversold and pessimistic. The key numbers to remember are 2.4 and 0.8. When the Mayer multiple climbs above 2.4, Bitcoin is considered expensive compared to its long-term trend. And history shows that tops often form not long after. And if it drops below 0.8, it's the opposite. Bitcoin is cheap and usually near a bottom. Right now, the Mayer multiple is sitting at 1.21. This means that Bitcoin is just a bit above its 200-day average, nowhere near overheated, and actually much closer to cheap than expensive. And in past bull runs, this number has climbed much higher before a true cycle top. For us, this is a reassuring sign. The market isn't stretched or overbought. In fact, there's still room for more upside before we need to start worrying about a major top. The Mayer multiple makes it easy. Check where we are compared to the 200-day moving average and see if things are getting out of hand. Right now, the reading is calm. There's optimism, but not mania. Now let's dig into on-chain indicators, the raw blockchain data that reveals what holders are actually doing, where the supply is, and whether we're heading into a dangerous territory. Next up, let's talk about the MVRV Z-score. This is one of the most powerful and one of my favorite on-chain tools. This one digs straight into Bitcoin's DNA, using data that comes right off the blockchain and tells us if the market is getting ahead of itself or if there's still plenty of room to run. So let's break it down. MVRV stands for market value to realized value. So in plain English, market value is just what you get if you multiply today's Bitcoin price by the total number of coins. That's the sticker price the world sees on exchanges. Realized value, on the other hand, is a bit deeper. It looks at every Bitcoin and asks, when was the last time this coin was moved? And what was the price back then? It adds up all those prices to figure out the true average cost basis for everyone holding Bitcoin. The Z-score itself just measures the gap between those two numbers. It tells us if the current price is way above what people actually paid, which can mean things are overheated, or if it's still in line with historical norms. And here is why this is so useful. Every single Bitcoin bull run in history has ended when the MVRV Z-score spiked into the red zone, usually a score of 7 or higher. When this has happened, it has meant the market value has gone wild compared to what holders actually paid. So when this happens, that is when euphoria has actually peaked. And it means tops are just around the corner, and it means the market's going to be crashing, basically. Not like down to nothing, but a big correction. And right now, the orange line, the Z-score, is hanging around 2.5 to 3. That's a healthy level, guys. It means Bitcoin's price is a bit above the average cost, but nowhere near those overheated extremes that have marked previous peaks or tops in the market. And actually, back at the bottom of the last bear market, the score actually went below 0. The green zone, signaling that everyone was underwater and things were likely about to turn. So what's the takeaway? The MVRV Z-score says we're running hotter than we were months ago, but the market still isn't in danger territory. There's positive momentum, optimism, and some profit taking, but the kind of FOMO that signals a true cycle top just isn't here yet. Next, let's talk about the fifth indicator. This indicator, the NUPL indicator, goes straight to the heart of investor psychology. NUPL just stands for net unrealized profit and loss. This tool takes the pulse of every Bitcoin holder and asks a simple question. If you sold right now, would you be in profit or at a loss? Here's how it works. NUPL looks at every wallet on the Bitcoin network and checks whether those coins, if sold today, would make their owner money or leave them underwater. All those answers blended together into a single number that shows how the market is feeling. NUPL runs from -1 to +1. If it's -1, almost everyone is sitting on losses. So this paints a picture of peak pain and usually lines up with major bottoms. If it's at 0, on average, holders are breaking even. And when NUPL is up +1, everyone is deep in profit and euphoria is in the air and there's fantastic parties. It's everywhere, okay? It's like Christmas. Those have historically been the moments just before a cycle top too. So where are we right now? Today, NUPL sits around plus 0.60. That's firmly in the greed zone. People are confident and sitting on healthy paper profits. But we haven't reached the kind of feverish euphoria that usually marks the end of a cycle. In the past, major tops have come when the NUPL climbs even higher towards 0.70 or 0.75. That's when almost every holder feels like a genius and profit-taking spikes. And something to remember is that even after recent pullbacks, the NUPL hasn't dipped below zero. This means that most people are still up on their positions. Fear and capitulation have not taken over this cycle. NUPL is showing strength and confidence, but not mania, which is good. It's a classic mid to late bull run signal and tells us that things are heating up, but the temperature isn't boiling yet to a point where it's gonna topple over, And so now let's wrap up with one of the most visually striking indicators out there, the HODL waves. If you've ever wondered how much Bitcoin is being held by long-term believers versus new, fast-moving money, this chart has your answer. Here's how it works. HODL waves take every single Bitcoin in existence and sorts them by age, how long they've been sitting in a wallet without moving. Coins that haven't budged for years sit at the bottom of the stack, for instance, like ancient bedrock, and freshly bought or traded coins from the colorful layers at the top. But this chart adds a twist. It doesn't just look at how old the coins are. It also weighs each layer by what those coins actually cost their owners, giving us a true sense of where the big money is parked. And why does all of this matter? It matters because when you see lots of coins staying put, it means the most experienced and often the wealthiest holders, sometimes called diamond hands, aren't selling to the high. This is always a sign of real conviction and long-term belief in Bitcoin's future. While on the other hand, when the chart shows a big bulge in young coins, say less than 6 months old, it usually means a wave of new buyers has come in at a higher price and enthusiasm is running high. And what does the chart tell us today though? Right now, coins younger than 6 months may take about a third of the total value. That means there's fresh excitement and plenty of new money entering the market. But long-term holders still control a huge chunk, which is really good. Roughly 40% of all value is in coins that haven't moved in the last 2 years or so. That's a powerful signal. The old guard hasn't rushed for the exits and confidence remains high. In past cycle tops, young coins, being held by young holders, new holders, have made up more than half of the market's value. Something that's very dangerous because like a young child holding anything, what do? They tend to break things, throw it away. They don't know the value of it, right? So when we do see, again, over 50% of the market's coins being held by new holders, this is the kind of frenzy that signals euphoria is here, and we are at the risk of a major reversal. But today we're not there yet. There's plenty of fresh energy, but the foundation is still strong, being held by diamond hands. So in short, HODL waves show us that Bitcoin's market right now is a healthy blend between new excitement and old conviction, diamond hands. The party is lively, but the veterans are still holding down the fort, as they say. Altogether, these indicators help cut through the noise, giving us a real sense of where we stand in the cycle and what to watch for as things heat up. So with the full spectrum in mind now, let's talk about what it means for your strategy right now. Across every major indicator we've covered today, global liquidity, trend signals, on-chain data, and the very heartbeat of holder conviction, one thing stands out. We're not at the peak yet. The data just isn't flashing those historic warning signs yet. Yes, momentum is high, and yes, there's real optimism, but we're nowhere near the kind of mania and euphoria that's marked previous cycle tops. If you've been here in past cycle tops, you know what I mean. So this is what is so important, because in crypto, the market doesn't go up in a straight line forever. There will always be pullbacks and shakeout, and that's where grit and conviction matter most. So it's not just about riding the rocket, okay? It's about having a smart plan for when to step off, locking in your life-changing gains before the music stops. You don't want paper money, you want real money. Remember, you don't have to figure this out alone either. We're here every single day, Monday through Friday, bringing you the best data, the real signals, and a straight up honest perspective too, I would say, and helping you make smarter moves, whether that's holding strong or knowing when to take profits. And hey, if you want to see exactly what Wall Street is planning for altcoins next and how it could affect your own strategy, make sure to check out yesterday's video here. Stay sharp, stay focused, stay relentless, stay early and healthy. Have a wonderful weekend, guys. This is your cycle, so let's make it count. I love you, and I'll catch you guys here on Monday. Ciao.